Well, can you hear me now? Okay. Well, thanks, Brent, for asking me to speak. And you guys, I've been a member of Sioux Falls, New and Sertoma for a long time. So today, I'm going to kind of take the approach. I'll kind of go over what a reverse mortgage is, some of the myths. But if you have questions, just ask me. Don't wait till the end, because if you're like me, I forget my question that I wanted to ask. So with that, I've been working, this is my 18th year in the reverse mortgage industry. I started back at Wells Fargo in 2007, wondering what I was getting into. And I fell into where it's my passion now. I love helping people who want to stay in their homes. Half my customers historically have been veterans or the surviving spouse. So I think that's something that's very unique that I've identified. And as a veteran, that's really my focus. If I can help anyone stay in their home, but it's extra special to me when it's a veteran. So what is a reverse? You could go to Tom Selleck commercials. You can go to Google. You're going to get your good and bad. For South Dakota specifically, the only reverse mortgage program is the FHA reverse mortgage. So it's backed by the Federal Housing Administration. And to be a borrower, you got to be 62 or over. And that's how it's designed. And it allows you to take a portion of your equity and use it while you live there. And then the loan is paid back when you no longer live there. So the benefit of that versus a home equity line, you don't have a monthly payment. What I see across the board, the number one issue that seniors have in retirement is cash flow. They might have money in investments or other things, but if they're not liquid, and now they're having to sell an asset or take money out of it, and if it's taxable, now they're getting put in new tax brackets. So by far and away, the number one thing I see is cash flow. Because you're using your equity in a reverse mortgage, it's a loan, it's not considered income. So I've had a $36,000 homeowner use it and a $3 million homeowner use it. I had a customer here in Sioux Falls. I asked him why he did it. He said it was basic arithmetic. He goes, why leave the money in the bank and make payments every month, and then take the funds out of his portfolio? He used the funds from his departure residence. He had to put about 50% down on a $600,000 house. He's lived there now for over 10 years. He's not made one payment, just pays his taxes and insurance and HOA. And he left all his funds in his portfolio for his 4 children. And needless to say, when he goes to the next better place, his kids are going to be set up very well. But he never touched his portfolios other than what he had to. So that was probably...
Question. When he dies, he goes to another place. He's got a balance, but what happens to that balance?
I was hoping somebody would ask that. So Jim just asked a great question. So he's been in this home. So what happens when him and his spouse die and now the loan is due and payable when you no longer live there? What happens to that loan balance? Because it's accrued interest for 10 years. For this case, I've looked at where his home is at in Sioux Falls. He's had major appreciation. So even if we doubled his balance on a 10-year term, it'd be $600,000. That home today is over $900,000 based on all the numbers. So when he no longer lives there, him and his wife no longer live there as their primary residence, they'll sell the home, or the kids will sell the home, pay off the $600,000, and then the other $300,000 will go to the estate. So they'll still walk away, but he did not have payments for these past 10 years.
Okay, good. So what if he doesn't have any equity?
I love this question. Jim, I think we talked before this because this is where I wanted to go. So what if he didn't have any equity? So he's blessed to be in Sioux Falls, and we've had home appreciation and everything like that. I just saw Yankton is losing their beef processing, so they're going to lose 277 jobs. So let's just use example Yankton, because they said right now Yankton's market is down about 25%. I was told this about a month ago. And now you have this hit. So let's just say they did the home $600,000 in 10 years ago. Did the loan, it got $300,000. So his loan started at $300,000. It's now doubled. The loan has doubled, but the house now that was worth $600,000 went up to $700,000, is down 25%. So let's just say it's only worth $500,000 for the example. So he's upside down by $100,000. Anybody have a guess what happens to that shortfall, that upside down?
Uncle Sam.
What do you mean by Uncle Sam?
Well, they'll take the loan and make up the difference because it was insured by that.
So Jeff hit the nail on the head. So what will happen, this is an FHA insured loan. You pay a mortgage insurance premium every month as part of the loan. It goes on the loan cost. In that case, if it's upside down by $100,000, FHA will cover that loan. So the family does not owe that.
So the family walks away.
So the family walks away, said, hey, we don't get any equity out because it's upside down.
Been in the house for 10 years, paid no payments, just taxes, insurance.
Yep, so just to recap what Jim just said, the customer lived there for 10 years, paid taxes and insurance, now walks away and doesn't owe that $100,000 shortfall.
So based on age would be the ratio of what they let you borrow against the true value. Is it by your age, or how do I know how much you're going to give me? Let's say I got a $500,000 house and I'm 67. What, do they base your lifespan on probably 85 or something?
Another great question, so I'll repeat it. What Jeff is asking, so how do they figure out how much they will lend? Is it based on age or what's it based on? It's based on the age of the customer, so life expectancy, the home value, and current interest rates. So, like right now, I looked earlier this morning, the 10-year treasury rate's kind of hovering. I want to see the 10-year treasury rate go down, because as it goes down, it gives more funds to my borrowers. But the life expectancy, somebody at 85 years of age is going to get a lot more than somebody at 65, because FHA is building that cushion in there. So if you live there a long time, that loan's going to accrue interest over that time.
And isn't that based on the appraised value of the
It's
property?
based on the appraised value of the property, yep. So as part of the process, once a customer is ready to move forward, they have to do this required FHA counseling to make sure they know they have to live there, pay property taxes, insurance. It's just a cover for FHA and the lenders to make sure that they're not getting misled. As simple as that. And then you do the application, then it's appraisal, title work like a normal transaction.
So is the consumer paying for the appraisal, and what are the other costs?
Great question. So is the consumer paying for the appraisal, and what are the other costs? I'm just going to start from the top of my sheet, so I hope I don't forget anything. The very first thing, you're going to have a mortgage insurance premium of 2% of appraised value to FHA. It's the biggest cost of the whole program. Then you're going to have origination fee that's based on value capped at $6,000 max. And then you have the normal appraisal, title work, all that good stuff. That's rolled into the loan, so you don't have to pay that. Now, my company, I work for University Bank. They're a federally chartered bank out of Michigan, so I can lend in all 50 states. In my 18 years, this is the first time I don't have to collect for an appraisal up front. We'll roll it into the loan. So most times you got to pay for the counseling because the lenders are not allowed to pay for that. And then you got to generally pay for the appraisal. But right now, the only cost is that required counseling. So very good question.
That 2% up front is not up front. That comes out of your loan every month. You don't
Yeah.
pay that. You don't pay that out of your pocket.
So Jim clarified, I said it was up front. It goes on the loan balance day one, but you don't pay that. So if you had $1 million home, you're not paying me $20,000. That $20,000 is going on the loan. So I tell people, if you're going to do a reverse, you're not doing this for a year. You're doing this for at least 3 years minimum, so you can break them costs down over an annual basis, because otherwise, it's not worth it. Really?
Yeah, so if I've got a house that's paid for, just say I want to take out a couple $100,000, give each one of my kids $100,000, do they have to claim that as income?
So Willie asked a great question, and I might defer, after I answer, I'm going to defer to the financial advisors or tax people. So I have a house that's worth a couple $100,000. I want to give my children some. Do they have to claim that as income? My understanding, if it's greater than the tax, whatever the IRS says is a gift, they would. But I will tell you this, I have had people that do the reverse. They leave the money in the line of credit because you could either take some of the funds at closing or leave it in the line of credit, and each year they gift their kids under that amount so they can get it to their kids over time.
Well, my question really is I think I can give my kids $14,000 a year, 18 or whatever it is. But if I take, 20 or 25, that doesn't work, right?
That's my understanding is,
Well, you can, but then you have to file gift tax returns, and that reduces that from your estate.
Okay.
Which right now is still well over 13 million.
Oh, good.
okay, I'm gonna give him the mic so everybody can hear this, because this is important.
I can't remember what I said.
I can relate to that.
What was the question?
I think the question from Willie was, can you gift to your children? You certainly can. I think for 2025, it's 18,000.
Okay.
And then, but if you gift in excess of that, and that one particular year, then you just have to file a gift tax return with your CPA, and then that'll reduce from your estate. So you can whittle away at your estate by more than 18,000 every year, but then you gotta file a gift tax return. But if you only give 18,000 or less, you don't have to report to anybody.
Okay.
Thank you for answering that. And your wife could give 18 too, right? If your spouse, each one could? Yep, that's what I thought.
To your son and also to daughter-in-law. So between, we can give tax 18.
So about half the time, I'm paying off an existing mortgage, which I tell people,
Now,
if you have an existing mortgage, let's say it's a $50,000 balance. If you're in your 20s, 30s, 40s, 50s, that's a small balance because we're probably likely working yet. But if you're in your 60s and 70s and 80s and you got a $50,000 balance, that's generally a payment for as long as you live in the home or for some the rest of their life. So if we pay that payment off and we get rid of that principal and interest payment, that's where the benefit, generally what I see is a cash flow by far and away. I've had people where we've done that and they say, okay, we wanted to retire and we'll go down south for a couple months, but we still had that payment, we couldn't. Now, they don't have that principal and interest, they save that up and they go down south for a month or two and make their life a little easier. So just different things I see.
Hey, Jake, what's an average payment? How much money do I get a month then if we do?
You asked what an average payment is on a reverse. In my 18 years, so what I think he's referring to is you hear the commercials, you get a payment for as long as you live in the home and all this stuff. In my 18 years, I don't think I've had 18 people that have done it that way. They either take the funds because we're paying off the existing mortgage in a lump sum, or they leave it in the loan where it's in the line of credit, and if you don't take it, it's growing. So if the interest rate on the loan is 6%, the funds in the line of credit are growing at a 6% rate too. So the next year you have 6% more available. So great question.
I think it depends on what your goal is, okay?
Yes.
Goal is if you want the money now, if you don't want to make a payment, you go that route. Otherwise you go like this and let it grow.
So,
A lot of
yeah.
people just don't want to ever make a payment again.
Yeah. So a lot of times the people take the money at closing because they have so much they can access the first year. They take all that at closing, generally. It's 60% of the available funds, and they'll take care of their debts that they have. We might be paying off the first mortgage. They might have a credit card. They might have an auto loan that we take care of. So they get rid of all their debts. And then the second year, when those other funds that are in the line of credit that are available, if they don't need it, they leave it sit there. Now, let's say you have a couple, you don't have long-term care insurance, you're sitting on a really nice place, and one of you has to go to the next level of care. Should you have a reverse mortgage set up in advance or wait till after the one's in the facility?
oh, always in front.
Jeff hit the nail on the head. So I ran into this for a customer up in Mobridge. She only had a $50,000 first mortgage. The home was worth $150,000. Her husband was in the nursing home. I said, well, before we do this, let's see if they file a claim for Medicaid. There was over $150,000 owed between the two. Obviously, I couldn't do the reverse because they were sitting there. She goes, should I pay extra on my home? I said, I would not pay extra on your home loan. Pay the very minimum because your care is going to eat everything you have in that home. So she literally looked at, now she was paying rent to stay in her home. So something that, I ran into. So you say, Jake, I want to do a reverse. Who keeps title? Does title stay in my name if I do a reverse, or does it go to the bank? It's one of the biggest myths out there.
I would think FHA would sit on it, but I'm probably wrong.
They have a lien against. So title stays in the name of the borrowers. Just like if you have your home free and clear and it's titled in your name, or you have a conventional loan, it's the same thing. FHA just files a claim, just like your current mortgage company would have it.
So go back to your Lydia and Mobridge. Had they taken out the reverse mortgage, had that lien against their house, could the nursing home have filed a lien against their home?
So Brent's asking about the case in Mobridge. If they would have done the reverse before he went to the next level of care or filed the claim, could the nursing home file a claim? Yes, in second position. We could have paid off the existing mortgage, freed up that cash flow for her. The reverse would have been sitting in first position. The nursing home would come in after the fact when it got sold and take what's left after the reverse was paid. Great question.
Insurance. You still have to carry insurance? Okay, now, if you do, what happens if you have, say your house burns down, and you and I all know you can't rebuild for what you already paid into the house?
So Jim's asking, okay, so you have to carry insurance. I said you had to carry insurance. Yes, you have to pay for that. What happens if the house burns down and it's not enough? Doesn't matter if you have a mortgage on it, a conventional or reverse. If you don't have enough replacement costs right now, you better be going talking to your agent. So like my house, when I built it in 2011, it was during the recession, had $270,000 into it. When my insurance agent came out, he goes, how did you build it for this? He had to get waivers through the insurance company for my replacement of $450 in 2011. If I would have done 270 and we had something, I would never be able to rebuild. But that's where you really have to have an insurance agent that you know and trust, and be careful that there's one company that I know of, and I won't mention it because I'm recording here, that they're notorious for having under coverage and lower premiums. So they get a lot of stuff, but they had to pull out of the Rapid City market because of hail and wind.
I got a follow-up question on that. So your house is worth X amount of dollars, okay? And it burns down, and the loan is higher than what the value is. So what happens? Does the insurance company pay off the loan, or does it let you rebuild your house?
So good question by Jim. So let's say let's use the example down in Yankton where they're already upside down. They're still living there. So the loan amount is already $600,000, and the home's only valued at $500,000. What's replacement cost? Replacement cost on that home is probably well over $600,000. So they're going to rebuild that home to meet the standards, and if it's still only worth $500,000 when you sell it, that's going to be covered by FHA.
So will FHA, do you just continue to make your,
You just-
FHA just continues to own, and you rebuild your house?
Yes. Yep. Great question. So Palisades fire in LA, there's a lot of people that had loans.
So Jake, what you're suggesting is people, when they insure, instead of all the, I don't know, co-insurance or whatever all the half crap is, if there's a thing called replacement, which they kind of give it a small index on. I've always had a replacement. I had a house fire once, and it saved me several $1,000s because they do a printout. Here's what we would normally cover, but your house needed this because this is what you had. And I paid the $500. Well, I didn't even pay the deductible when we got done. That's a long story.
Yeah.
But that made a big difference.
Yeah, so what Jeff's pretty much saying is make sure you have the correct replacement coverage. Separate if you have a reverse or what you have.
Can you do a reverse mortgage on a concrete home or a mobile home or something like that?
I can do it on a mobile home if it's on a permanent foundation. And I see no problems with a concrete home because it's not going anyplace.
Fill out Eric Feeling report.
You could also buy a home using a reverse mortgage. So that those people that I mentioned in Sioux Falls that did the loan like 10 years ago, they bought a new home using the reverse. So they was $600,000. They had to put $300,000 into it. The other $300,000 to make the builder whole came from the reverse. So they actually bought a home using a reverse mortgage.
What about a commercial property?
Has to be your primary residence. So commercial doesn't work, Ray. Good question though.
Wife makes you live at work, but.
Because I do.
Well, if you have more questions, I'm just